What you're about to hear is not theory, and it is not historical analysis. This is a real-time event that unfolded while most people were asleep. Within the last 48 hours, the geopolitical landscape shifted violently. According to official confirmations, the United States has initiated direct military action on Venezuelan soil. Elite American special forces carried out targeted operations, and multiple sources, including Reuters and U.S. officials, report that Venezuelan leader Nicolas Maduro and his wife were captured and removed from the country. This is not rumor. This is not social media speculation. This information comes from confirmed channels, including statements attributed to the President of the United States, who announced that further details would be disclosed at an official press event at Mar-a-Lago. The chessboard has not just been rearranged. It has been flipped over entirely. While mainstream coverage fixates on political narratives and diplomatic framing, the far more important question is what this means for capital, for risk assets, and for real money. Because history shows that when governments fall, when military power is deployed, and when uncertainty explodes overnight, financial markets respond in very specific and predictable ways. And silver sits directly at the center of that response. For over 5,000 years during wars, regime collapses, currency resets, and economic shocks, precious metals have functioned as the ultimate refuge of purchasing power. When paper confidence breaks, capital moves instinctively toward assets that do not depend on promises, politics, or counterparty trust. Before this news broke, silver was already climbing. Spot silver was trading at $72, 39 per ounce, up 1.6% on the day. But that price was formed in a world that still believed it was stable. It was formed before the market processed the reality of U.S. military action in South America. It was formed before investors understood that a sitting head of state had been seized by foreign forces. That world no longer exists. Markets do not price in geopolitical shock smoothly. They reprice violently. And the technical picture confirms this stress. Earlier this week, silver reached an all-time high of $83.62 per ounce, the highest level ever recorded in modern market history. This was not a test of resistance. This was a breakout into uncharted territory. What followed was a sharp pullback toward the low 70s. That move was not weakness. It was structural consolidation. After parabolic advances, markets must reset positioning, flush leverage, and establish new support zones. That pullback occurred before the Venezuela operation. It occurred during relative calm. The context has now changed completely. Geopolitical shock injects urgency into capital flows. Fear overrides models. Correlations break. The safe haven bid accelerates. The $75 level, which traders have been watching for weeks, is now positioned to be attacked from below, not defended from above. At the same time, macroeconomic conditions are already stacked in silver's favor. Futures markets are pricing in at least 2 Federal Reserve rate cuts in 2026. Falling rates reduce the opportunity cost of holding non-yielding assets. When cash yields decline, silver becomes more attractive by default. The tailwind was already pushing prices higher. The geopolitical escalation only intensifies it. Then there's the dollar. Normally, a firmer dollar would pressure metals. But crises do not respect textbook relationships. In periods of extreme uncertainty, both the dollar and precious metals can rise simultaneously, as investors abandon risk assets in favor of perceived safety. We have seen this during COVID. We saw it during the invasion of Ukraine. We are watching it begin again. Energy markets add another layer. U.S. crude closed at $57.32, Brent at $60.75. Prices set before the implications of Venezuela were fully understood. Venezuela is an OPEC member with vast oil reserves, even if infrastructure remains intact. The geopolitical risk premium does not depend on physical damage. It depends on uncertainty, escalation risk, and supply disruption potential. Rising oil prices translate directly into inflation expectations, and inflation remains one of silver's strongest allies. Technically, the $70 level is now the line that matters, as long as silver holds above it. The broader trend remains intact. Any dips toward that level represent positioning opportunities, not breakdowns. A decisive move above $75 opens a clear path, back toward $83.62 and beyond. Institutional flows reinforce this picture. The largest silver ETF, SLV, closed at 65.75s, up roughly 2% on the day. This vehicle holds the equivalent of roughly 65% of annual global mine production. When fear rises and institutional money seeks hedges, inflows into SLV force physical metal purchases, tightening supply and amplifying price pressure. The calendar ahead only adds fuel. Markets are watching for official statements, confirmation of scope, and signs of escalation. Any indication that this is not a contained event keeps a bid under precious metals. Economic data next week will influence rate expectations, but geopolitical shock now dominates the narrative. Even if escalation fades, the underlying case for silver remains intact. Structural supply deficits, exploding industrial demand from solar and electrification, a Federal Reserve entering a cutting cycle, A dollar burdened by fiscal reality, every major force points in the same direction. There are risks, and they must be acknowledged. Rapid de-escalation could compress the fear premium. Strong economic data could delay cuts. Broad market liquidation could drag silver temporarily lower. Paper market interventions could create violent intraday swings. But none of these invalidate the long-term thesis. They create volatility, not reversal. From a positioning standpoint, the setup is asymmetric. Upside potential significantly outweighs managed downside risk. For physical holders, the strategy is even simpler. This is not a moment to liquidate real assets for paper claims. Dealer premiums are already elevated. Supply chains are strained. If fear accelerates, availability will disappear first. Price will adjust later. This event is not isolated. It is part of a broader shift toward geopolitical fragmentation and hard asset repricing. The era of assumed stability is ending. In that environment, precious metals are not speculation. They are insurance. Silver is not reacting to headlines. It is responding to a world that just became more dangerous, more uncertain, and more hostile to paper wealth. The question is no longer whether silver will reprice. The only remaining question is whether people position themselves before the market finishes doing the math.
Hello everyone, welcome back to my new informative video. So friend, let's start. What you are about to hear is not theory and it is not historical analysis. This is a real-time event that unfolded while most people were asleep. Within the last 48 hours, the geopolitical landscape shifted violently. According to official confirmations, the United States has entered directly military action on Venezuela soil. Elite American special forces carried out targeted operations and multiple sources, including Reuters and U.S. officials, report that Venezuela leader Nicolas Maduro and his wife were captured and removed from the country. This is not now. This is not social media. This is not speculation. This is information comes from confirmed channels, including statements written to the President of the United States, who announced that further details would be disclosed at an official press event at Mar-a-Lago. The closeboard has not just been migrated. It has been for our entirely when mainstream coverage fixed on political narrative and diplomatic farming. The fear for more important optimization is what is the means for capital for risk.